Greetings, everyone, and welcome back to GTR Asia 2021 virtual. I'm Olivier David from Atradius, and I've got around me some expert guests to discuss credit risk, insolvency, and domino effects, how prepared the market is for the for the more turbulence in the coming year. We had over the past 2 years some large fraud. We have some large losses. We had Greensill. We had banks decided to withdraw from the commodity finance. And we also have people even withdrawing from Asia. So quite interesting time. And I'm really looking forward to hear from our experts who are around me. And we are going to start to see how each one of them is going to answer to this question. But first, I wanted to encourage you to ask questions. You have the possibility to send questions to all of us, and we'll be able to answer to them for the next 15 minutes. We are going to start with our guest. Maybe I'm going to ask you, the four of you, to introduce yourself, not only the job you do now, but also your past experience, which make you expert in this topic. Thank you. Maybe Diane, you can start, please.
Thank you, Olivier. I feel like I'm a bit of an outlier in this panel because I'm not an industry person, but I represent the industry. So I'm Diane Tate. I'm the CEO of the Australian Finance Industry Association. We represent over 130 lenders in Australia. So that's large banks, finance companies, fleet and car rental, and fintech lenders. So the entire finance sector. Before this role, I did work in government and I worked in our conduct regulator, ASIC, and I also represented the banking sector for a number of years in Australia and also internationally. So you could probably say that, you know, I can think like governments and I can talk regulator speak. So I guess one of the things I bring to this is thinking about the domino effect. You know, how do you introduce the chess game to dominoes? Because it's not simple what we're dealing with right now. This is crisis. And out of crisis comes often overreach from regulators, and governments get overwhelmed with how to respond. So I guess that's my skill set, is thinking about the big picture.
Excellent. Thank you so much, Diane. Roshni, welcome.
Hi, good afternoon, good evening, everybody. Thank you, Olivier. My name is Roshni Patel. I've been doing credit risk for the past 15 years, Olivier. So the expertise I bring to the table is working with financial institutions, whether they are insurers, banks, or corporates, over the past 15 years. As a consultant, working in a bank itself, working for vendors and software companies as well. Now I work with Quantexa, which is a new organization that's been up and running for the past 5 years, which is very much about taking institutions to the next level, the next generation, and pioneering in combining data and contextual decisions together to really look at hidden concentrations, think about contextual decision-making and automated decision-making. And when we think about things like Greensill, Olivier, you mentioned, you know, what was really connected with Greensill as an example. So Quantexa today is really for pioneering in leading not just AML, fraud and financial crime, but customer insights, credit risk, and really thinking about how does that affect banks, corporates, and insurers today. So from my perspective, a bit like Diane, I bring the credit risk, financial services expertise to the panel today.
Excellent. Thank you so much, Roshni. So Sean.
Thank you, Olivier, and good day and good evening to everybody online. So my name's Sean Birrell. I'm the CTO and co-founder of a company called Veridapt. And we're an industrial IoT company that has a decade and a half experience of monitoring and controlling the flow and movement of commodities around the world. And I think our perspective for today's panel is we as a business weren't always involved with bankers, financiers, insurers, in structured trade finance. We came from an operating background where, our customers were large scale producers, but we had a bit of a light bulb moment a number of years ago really related around the physical frauds that had occurred in supply chain finance and those physical transactions where, commodities had gone missing or weren't of the quality that maybe was expected. And I think, today's discussion is going to cover a range of the challenges that the industry faces, but there's lots of different pieces of that puzzle that need to be solved. And I think that our perspective is around providing real-time data and telemetry data as to the quality and quantity of inventories in locations around the world to banks and insurers to help give them comfort that those commodities are secure and maybe help deal with some of those perceived risks in physical transactions, whether they be asset-backed sort of borrowing-based structures or repo structures indeed. So that's, I guess, the view that we would like to explore in that piece of the puzzle, but understanding that there's a range of other pieces that all need to work together to help, I guess, the industry navigate the challenging times it has at the moment.
Excellent, Sean. Thank you so much. Alex, last but not least.
Yeah, thanks, Olivier. And yeah, hello, everyone, and thank you for the invite. It's a pleasure being on this panel. My name is Alex. I'm the Regional Director for Insurance for LiquidX. I'm based in Singapore and covering APAC and Middle East. So I've been in the trade finance industry for around 15 years plus, thereof 12 years in Asia. So my previous experience on the banking side, but I was also previously with Euler Hermes. I was in the underwriting side, but also in the distribution side. So I saw a couple of claims, disputes happening in our industry, starting from the global financial crisis, 2008, 2009, but also the commodity crisis, which brought a number of claims in 2016. Also, the pandemic was an interesting and still ongoing interesting time. So where I'm coming in is we are more coming with the technology angle. So knowing how banks operate, how trade credit insurance operate. We are working closely with credit insurance brokers, with underwriters, banks, asset managers. So I will try to chip in and see how we can focus on KYC, how we can forecast payment patterns, how we can screen invoices, which are currently physical assets, turning them into digital records, seeing how it can work seamlessly with trade credit insurance policies, the transparency, eligibility for cover. So this will be the main points I'll be covering. Great to be here.
Excellent. Thank you, Alex. So you see that we've got some wide expertise in finance, in fintech, in insurance, and that I think it will help us to cover the broad spectrum that will help somehow or find a solution or advice how we might see to bring back the equilibrium around the risk appetite, and also maybe foresee what the government support ending their financial support to the economy, and if this is going to be a solution for this, or are they going to be a wave of default with the zombie companies? Now, where is the market, and are the new regulation going to help? This is all type of topic that I like the panelists to express, and also going from each of you in your part of the market. How did you go through the crisis? How did what are the main aspects that you saw over the past 2 years, and how do you see which aspect of what you do are going to bring this confidence back? So maybe we are going to stay with you, Alex, and maybe start with your a few points on this topic.
Yeah, sure. I think I would like to step back and say the pandemic has shown very clearly that supply chains are becoming more fragile and also more regional. I think companies who already struggled before COVID have really turned into, so to say, zombie companies, surviving purely due to support from the government. And here it's important to say what Diane has mentioned. So it obviously creates a crisis, but crisis usually also create opportunities. So we see more and more technology coming into that space. So for instance, what we have launched just recently is a digital policy management tool where you can look through invoices purely or bills of lading, purchase orders, which were just a piece of paper or PDFs, which we turn into a digital record and then combine with, let's say, the terms of conditions of a trade credit insurance policy, which gives many players more confidence. So Olivier, you mentioned the point confidence and trust. Big benefit for corporates, banks, but also insurance carriers. Why? You see more transparency in what's happening in those invoices, right? This is one thing. Coming from the insurance background, for example, turnover declaration has always been a big topic. Now technology can provide really a deep down drill what's behind the invoices. Are the invoice eligible for cover? Do we see some patterns which are irregular? Is it potentially fraud behind it? More focused on KYC, KYT, know your transactions, know your customers. Banks have faced a lot of regulation, and this is where technology comes in and tries to make life easier. And maybe on the final point, Olivier, you mentioned that some players left the market. There were substantial claims which forced some players to leave, but there are also new players to come into the market, right? Banks, asset managers, technology companies. I think one thing is for sure, and then I will forward to my fellow panelists, Singapore and also Hong Kong will remain trading and finance hubs. Yeah, so we are here to stay, but we need to find smart solution, digital solution to make the market more efficient and more transparent.
Wonderful. Thank you so much. Diane, from your point of view, I think from where I come from, you are on the other side of the planet. But also for me as an insurer, you as a banker, you are also on the other side. And you might have some different perspective also from your competitors who left the market in APAC, but also your view on the various regulator or government action that has helped and maybe will help also in the future, in addition to what the private companies, banks, and insurers can do.
Yeah, thanks. I might take a slightly different tack to Alex, because he sort of talked about the sort of supply chain finance sector specifically, and I think everything he said, stands for trade and supply finance in Australia. Supply chain disruption is a problem now, an increasing problem, and I think that's something that we're going to need to keep a really close eye on in terms of next year and economic recovery. But from a perspective of the sector in Australia and how it engages as a small market in a global market and a smaller finance sector compared to financial services globally. It really has been, I guess, over a decade of the industry having to deal with, quite frankly, challenges to the way it does businesses, not what it does, but the way it does it. And this question about whether there is trust in the sector and the reputation of the sector being damaged, out of the GFC, there was clearly some questions about the purpose of financial services and finance more specifically. We've had a few other inquiries in Australia, similar to other countries, but also a little different as well, which have really put a focus on how financial institutions are behaving. So that conduct piece. I think we can all honestly say, though, that the global financial crisis may have put a spotlight on things, but things had already started to shift well before that as well. So if I think about how we've handled through crisis, I think we learnt a lot from the global financial crisis. I think that the governments, and particularly the Australian government, set things up very early on last year when COVID cases were emerging overseas to ensure that our financial systems, so our banks had support from our central bank and our non-bank lenders had support through government programs as well. And they took a real finance sector-wide perspective. And I think that's really helped the finance sector be able to do its role through this, which is to be supporting customers as much as they have been able to. There is, of course, a conversation about, the tsunami of insolvencies is sort of the media language we're getting in Australia, whether we really have got zombie businesses. A number of my members are talking about the strength of their books and their portfolio, that there are very low arrears, incredibly low trend-wise. So it seems there's a lot of cash in the system, and I do wonder how that sort of plays out next year as well. But I guess from a sort of a observational perspective, I mean, what have we learnt through COVID is, Alex is right, data was king beforehand, and data has become even a bigger king. I think, technology and digitization and data are trends that are continuing to accelerate. They certainly have their opportunities. But I wonder about humans as well. I think COVID's taught us that humans are really important. And so I think, it'll be very interesting to see how we harness human judgment and analytics and bring that together to make better lending decisions. You mentioned Greensill. I will mention it briefly. It's an ongoing investigation in Australia and overseas, so I can't say too much ahead of the conclusions of those things. But I have to say that, everybody who I'm talking to in the trade and supply chain finance sector in Australia is saying that was perhaps an outlier. But what it does highlight is the ongoing focus that governments and regulators will inevitably have, Greensill, COVID crisis or otherwise, transparency, making sure that customers understand what they're getting and that there is confidence in the system are going to continue to be a really important theme. And I think data is one of the answers to that, not only just from a risk management and lending perspective, but from an opportunity perspective to demonstrate that the industry is really serving its purpose, which ultimately is, ensuring efficient capital mobilization.
Fantastic. Thank you so much, Diane. Maybe, Sean, you can follow up in your views from mostly a fintech angle. How did you go through the crisis, and what do you think the fintech will help?
Yeah, sure. So as a business, like I said, we had a traditional line of business dealing with operators, and it was really only just before COVID started that we actually really started to talk to banks and financiers. So I guess we don't know anything other than this situation, but I think there was some bigger macro trends in play separate of COVID. And I think if you look at the history of fiscal thefts and frauds in supply chain finance, they're not particularly cyclical. And I don't know what the data is, but I don't know if it's been made particularly worse during COVID. A lot of these issues have been quite opportunistic, or they've been related to a particular company that's experienced particular pressure on their balance sheet, and things have gone awry. So I think that we came into it talking to customers that had a history going back not just 12 or 18 months, but 4, 5, 10 years of challenging aspects to structured trade finance, and that those issues had continued to the point where, as you were mentioning before, some participants had left that market. And so I think what we have really observed is that those remain, understand that they need to change the way they do business. And I think you're going to hear people on this panel constantly use the word transparency. But it is true that it has been, the root cause of a lot of the problems has been that lack of transparent data, whether that be in a receivables business or whether that be in physical structured trade finance, like our sort of focus is on. And so those people that remain in the business obviously see that they need to do it a different way. I think you even look at other participants, for example, inspectors or CMAs, they can see that there's challenges that, people in their roles have to rise to meet. And I think there's an acknowledgement that it has to be met because, if you look at the themes of this conference around sort of, the needs of SMEs, trade finance gaps, you don't have to come very far down the credit curve for it to immediately start to impact businesses that can't get access to credit. That top end of the market will always be banked, and it's a different sort of proposition. But, it's not far from those investment grade customers that, some of these concerns around asset backed or physical backed structures start to, have banks pull back. We are seeing some non-bank financiers, I guess, step into that role, but, there's generally an increased cost of capital in that arrangement. So I think what we would observe is that COVID has accelerated digitization, I think, and it's accelerated companies' willingness to look at technologies and adopt them potentially. But I think if you look at the particular concerns that our business is trying to focus on, they have a much longer history. And they go back, years further than the advent of sort of, this current situation that we find ourselves in. So I think what I would say is that, there's a couple of different arcs in play here. There's obviously this acute COVID situation that we find ourselves in, and particular concerns about the solvency of businesses that may have been propped up by governments. But there also is some more systemic structural problems that I think are being addressed. And I think technology is one answer to that. I think the role of CMAs and inspectors and how they can work together. And then, on the paper side, multiple pledging of inventories and things, there's probably arguably a role for more regulation and support for industry from governments in that space. So I think our observation has been that there's definitely a willingness from participants to look at the way they've done business. But you have that usual challenge of adoption, and that's hard. You've got to change the way you do business. You've got to bring all your stakeholders along for the ride. You've got to include credit, your deal origination teams, your middle office, your customers. And I think they're the things that are challenging. I think the technology in many of these instances is mature and ready, but, sort of to Diane's point in a slightly different way, it's the people, and it's bringing everybody into the fold, making them understand, the why, and that, there are needs that need, there are concerns that need to be addressed, and then hopefully, help that adoption and help create some new norms in the industry, because, I don't think it is in anybody's interest for, major players to be exiting the sector, or it becoming more costly and difficult for SMEs to get, trade finance.
Excellent. Thank you, Sean. Before we move to Roshni, we've got some questions, and maybe going to break a bit the pattern and asking some of those questions. First one is, with current supply chain challenges changing the way companies manage their inventory, how has this impacted on the products made available in the market to manage risk? Are there any concrete example of a major shift in requirements? I don't know if any one of you wants to answer this. So any change in requirement to the change in potentially managing inventories?
I could speak. Oh, sorry, Diane.
No, you go, Sean.
Look, I think one thing I would say is that we would believe that there's going to be an increasing opportunity or need for supply chain finance as companies hold more inventory. I think, there's definitely, I mean, we're a company that manufactures, electronics and sensors. I can tell you now, in our instance, we are undergoing that change where we're holding more inventory, but there's obviously much bigger examples where companies are pulling their supply chains closer to home, but they are looking to hold more inventory. So I think that is going to create a need for that. And I don't know if necessarily that requires new offerings from the industry. I think that, those structures and deals are in place, but there's probably, a greater need in terms of the size of the facilities that people need. And that's going to create some need for people to get comfortable with that. So I would say that's definitely one thing that has started to occur. And the other thing is, I would say, is as some of the new participants have looked to enter the market, certainly some conversations we've had from the get-go are, okay, if we're starting with a blank sheet of paper, how are we going to originate our deals in terms of the KYC, the KYT? How are we going to have that ongoing monitoring component to it? So I think it's a lot of that sort of origination, back office, middle office in business improvements that are really going to change. Again, the same types of structures, the same types of offerings, but, hopefully in a more cost-effective, transparent, there we go again with that word, but and secure way. So I would say that that's two responses to maybe the changes in supply chains. Sorry, Diane.
Okay, there. Thank you, Sean. Diane, yes?
Yeah, I agree completely. I think, from a market perspective, trade finance and supply chain finance is going to become even more important because, alternatives are term lending, and in, sort of times of uncertainty and volatility in markets, finding right-sized best price credit, which, maximizes your assets, matches your liabilities, is going to be incredibly important. So, I kind of almost see this market increasing in size, and Australia's market's quite small. We're already seeing some larger, the larger banks coming back into the market that they had left a few years ago, and some non-bank lenders innovating in this space. So I see it being quite creative to serve SME needs. If there's something about this crisis, though, I guess it's a real economy crisis. So we need to be conscious of that. And I think that gets to your point about making sure that we're conscious of how are these existing products dealing with the complexities of what businesses are dealing with. So if supply chain disruption is lengthening the supply of products, what does that mean to the type of finance that needs to be put in place and the flexibility around that? You know, for example, let's keep it simple. I'm waiting for a car. I've ordered a car. It's 6 months. No, actually, you know, it's going to be 9 months. Whoops, it's actually 12 months. So how do we deal with that on that sort of supply side? On the other side, I think one of the challenges that we are going to face as financiers is we're going to be asked to solve some problems that exist in the economy. And we've already had a number of our regulators in Australia and ombudsman call out payment terms, and larger companies potentially taking advantage of smaller companies is the example given, where they lengthen their payment terms. Industry doesn't want to be seen as making that problem worse, or in fact creating that problem. So I think how do we make sure that existing deals done at a time when you thought you had the right information, how do they change on both sides of the ledger to make sure we are, as financiers, we are helping, not making some problems that exist out in the economy worse?
Okay, thank you very much, Diane. Before we move to the other questions, maybe Roshni, you can share your view on how you went through the crisis and what you feel is going to be important for the near future.
Yeah, sure. Thank you, Olivier. And I agree 100% with what Alex, Diane, and Sean have said so far. And I think I'll touch on the word transparency as well. But, you know, you all mentioned transparency. And I think that's been particularly important when we think about the newer challenges, Olivier, that are going to be coming on board with the likes of ESG and climate change. So where institutions want to be able to go down their supply chain and be, what I use the words, a greener supply chain, you know, there's different types of fraud and there's different types of due diligence that now has to take place, because you can mischaracterize commodities, or they could be mislabeled as different carbon schemes just to get through your origination process so you go and invest in them. So from a credit risk perspective, it no longer becomes the credit risk of the borrower in the supply chain, but it becomes the risk of the whole supply chain itself. So very much from the borrower, the end buyer, the credit insurers, to Alex's point, and other parties involved. So I feel like one of the points is around ESG, where everybody, you know, Sean mentioned KYT, KYC, but I think it's almost like a KYX. It's not just about the customer or the technology, it's also the supplier, but everybody connected to that supplier. So there is an increase of due diligence that's required, and almost like a holistic risk management. I almost say we've got to look at it holistically. All of that risk assessment has to be done from top down as opposed to bottom up as well. And I guess one of the instigators for that is, and I don't know how many of our listeners today have read this, but in the UK, about 2 or 3 months ago, there was a Dear CEO letter specifically focused on trade finance activity. And the PRA here, and there's huge amounts of banks and operators who are in the supply chain, trade finance industry here in UK in a global level. And as part of this regulator letter to every single CEO in UK was, we have seen a lot of gaps, a lot of downfalls in the trade finance, in how you monitor your trade finance activities. And I think, Diane, whilst Greensill Capital was an anomaly, it kind of pushed the regulator to really monitor how banks and other industry providers are looking at trade finance. And if I could just summarize it in two or 3 points, Olivier, that letter talks about risk assessment. There wasn't enough done on the riskiness of the supply chain. They were looking at the risk of just the borrower and not everybody else, like I mentioned. The other was the counterparty analysis. Very much, how are you bringing in adverse media? Are you being dynamic enough around the counterparty assessment you're making? But also with the alerts and your early warning signals, go away and do your credit review first. Go away and think about your analysis for that counterparty, then set your limits. Do not set your limit for a counterparty before you understand where they are and the riskiness of the asset. And it also touches on the payment side, which I won't go into too much, but Diana already talked about the payment schedule and the payment pattern. And I think that's quite important to understand. A lot of institutions are now using this Dear CEO letter, where I talk to organizations in Singapore and in Hong Kong and Australia. They refer to this Dear CEO letter that we want to better in these areas as well, even though the letter came from the UK. And I think the only other point I would make, Olivier, is I think, Sean, you mentioned this, and Alex, you did as well, where the governments are reducing their support for COVID and they're expecting organizations to be on their own feet as they were. In the UK, whilst there's been COVID schemes globally, some have been tighter, like Singapore have been very tight in terms of what their scheme looks like. You've had countries like UK who have been a little bit more open in their COVID schemes. And so in average, over the past 18 months, they've probably lent out about £50 billion worth of COVID loan support. Now, there was an estimate recently that is saying approximately 35 to 60% of those loans could be fraudulent. Now, if we think about 35 to 60% of those COVID loans being fraudulent, it isn't only about your risk assessment because they are COVID, the government-backed loans, sorry. It becomes a reputational element that Diane was talking about. It becomes a government issue to act on the pressures that they're now going to have because it's public money. So how does the government, not necessarily penalize, but how does the government react to that with the banks in the UK? And I know there's similar percentages in European countries as well. But just to think about that, it's not just about the risk assessment anymore. It's about who is a can't pay versus who is a won't pay type of assessment as well. But that's a little bit of a summary, Olivier, just to kind of bring everything what Alex, Diane, and Sean have said together.
Oh, thank you, Roshni. It's quite impressive. Yes, please.
I was just going to say, Rosh, I just wanted to agree with your first point around that the needs for ESG reporting, for example, low carbon intensity supply chains. I think there's actually a positive side to that other than the obvious environmental benefits, which is that the types of improvements the companies are making around the transparency of their supply chains for supply chain financing or their own operational needs also help in this way. So understanding the provenance of your raw materials, understanding the underlying carbon intensity, they very much align with the needs of financiers, and other users or other stakeholders. So I think you're right. I think those disclosures around carbon intensity, for example, of a given supply chain are only going to become more rigorous and onerous. But there is some nice synergy between, the general need for information for other purposes, such as SCF, as well as the ESG side.
Thank you, Sean. I've got a specific question for Roshni. Can you give us more details of the latest banking priorities you are hearing from your clients when it comes to AML, fraud, and other financial crime solutions? How are your needs evolving, and what is the range of institutions you are working with?
Well, that's a very broad question. So thank you for whoever sent that question in. I could take up the rest of the 17 minutes, Olivier, on this, but I'm going to.
Let's try to be.
I will try to answer this in 2 minutes. So we work with all types of organizations. So right now we are seeing demand come from not just the tier 1 banking organizations, but also governments. So we're working with the UK government, and this is in the public domain, so I can say it. We're working with governments like the UK government, banking, financial institutions, insurers, corporates, and telecommunications, and trade finance specific companies. So we're working across segments in that way. In terms of priorities, the priorities we're seeing from, let's just pick banking because it is our largest priority domain and our focus. It's almost around 4 areas, if I can say that. One is around the AML and continuous perpetual, what I call it, perpetual KYC. So ongoing monitoring, ongoing due diligence in the market, and making sure that ongoing due diligence and the ongoing assessment of institutions is having a better anti-money laundering processes set up, or having better financial crime processes set up. So that's very much at the core. There's still a lot of negative news where institutions are being fined for not having proper AML and financial crime setups. There was a recent one in Middle East. There's been some in Europe. So that tends to be a catalyst for the demand as well from the regulators. The other part we're seeing a lot of investment and time coming to us is around the fraud management. So really helping institutions understand what is fraud risk, so the customer will not pay and never had the intention of paying, and what is credit risk. Therefore, it has to go under impairment loss or a credit risk loss where the probability of the customer defaulting needs to be higher. So which one is a truly can't pay because the company just couldn't recover from COVID, as an example, or which company was just acting in a fraudulent manner and will not pay. And the third angle, which we won't spend too much time on, I guess there's four, but one is around ESG. So we're seeing a lot of organizations come to Quantexa and saying, we used to look at data in very siloed way. We had credit risk data, we had finance data, we have origination data, we have external data, we have data over here that we're using for this ad hoc monitoring over here. How can we bring all of this data together to get one single customer view, add the layer of ESG on top, so we have the environmental data, social data, and governance data to really come up with a holistic view of a customer and the broader network and the connections that's in. So I've kind of wrapped the data, ESG, technology angle into one, but I'm conscious of also wanting to get through other questions. Hopefully that answers that question from the audience.
I'm sure it did answer the question, and I'm sure it was exactly what I was looking for. I've got indeed a number of other questions, and I think it's for all the panel. And the interesting one, and I think it must be on the mouth of many people, is about Greensill. And the question is, to what extent was the impact of Greensill due to KYC, non-transparency, and lack of due diligence, rather than any sort of failure in supply chain finance as a principle and the structuring of working capital solutions? So one question to all of you, so please jump in.
And maybe I can start with that, Olivier, because we've actually looked at trade finance and Greensill more prominently because, you know, we had the ex-Prime Minister, David Cameron, also an advisor to Greensill. So the publicity we got here in the UK was exponential when Greensill happened. And I agree with the comment that's been made. It isn't a failure of the supply chain per se. It is the due diligence and the holistic view of this, the risk that Greensill failed at. And so their due diligence process was very manual. And, you know, Alex, you talked about automating some of that. And Greensill didn't do that. And Greensill was only around for 10 years. So in that 10 years, they wanted to be a forefront in give loans to institutions who could quickly go pay their suppliers. But there was no due diligence in the speed of getting that loan out. And one of the entities, and an example, one of the entities that Greensill lent to was a AAA or AA rated organization. But when you look under the hood of that organization, which our technology has a capability of doing, is looking at the networks of a given organization. When you looked under the hood of one of the entities that they lent to, they were associated with approximately 50 other people, 100 other organizations, and at least 150 other documents, which were linked to Panama or ICIJ or any other kind of watch list type of documentation. And therefore, that is where Greensill kind of failed in that due diligence, not looking at beyond that one counterparty in terms of the risk assessment. I don't know if anybody else agrees or they have a conflicting or opposing opinion.
I agree. And I think the question's very well asked. I mean, it says that there were certain process things rather than product related concerns. And I think, it's an unfortunate timing because, as I said, I'm a fan of trade finance and supply chain finance being a solution to a number of SMEs and businesses challenges through this economic recovery. But Roshni, you said something before, which I think is really important about this, holistic view of risk management. I think that is something that is going to continue to be critical for all parts of the finance industry, but particularly trade and supply chain. I think if we can learn a lesson from the global financial crisis and the reactions from regulators to that, and they saw that as a crisis in markets, there was an introduction of critical infrastructure that increased transparency and made sure that counterparties were looked at in different ways. I kind of feel like we might be seeing the same thing happen at a product level in terms of what will be expected with supply chains. So what is this counterparty assessment going on? How much can you automate, but also the human judgment side of things? But, I think, in terms of sort of where the finance sector, we've talked about data and analytics, but, I really think that finance is going to find itself being needed much more early in the production cycle. To serve the economy and what the economy is going to need. And so that's a question I guess I have about, much more deep understanding of the entire counterparty environment. And it gets to your comments, Roshni, including supply chains and ESG and things like that as well. But I also see that we're going to have a sort of an integration of financial and non-financial solutions too. Buy now, pay later, it gets a lot of attention in Australia, and it's platform lending. We're all aware that platform is not a new word. It scares some regulators because they don't know what it means. But I feel like the finance sector is going to become more platform-like. It's not just a product anymore. It's a product, a service, a technology, it's disclosure, and it's the reporting requirements that regulators are going to inevitably require. And the industry wants as well, right? There's a commercial advantage to this, not just the compliance costs. So I'd ask the industry to look at it as an advantage. And how's regulators going to keep up with this? They're not. Right? Our laws are already out of date. Our regulatory structures are already out of date. And that's why I'm an advocate for industry standards. It's why I'm a CEO of an industry body that develops codes of practice. And we're in the early days of doing one on supply chain in Australia.
Wonderful. Thank you, Diane. I've got a following question, unless either Alex or Sean want to jump on the recent story. But the next question is greater digitalization of the CMA sector something of a missing link at present?
Look, CMAs and inspectors are certainly a group of stakeholders that we talk to. And I think that, with very little exception, they've been looking at technologies to improve their business, make both their business more efficient, but here we go again, more transparent to the end, to their customers and their stakeholders. And I think that, the difficulty of actually a true CMA structure now being insured, the costs associated mean that, those models of the past maybe aren't going to be financially viable going forward. So I definitely do think there is a role for, we sell a digitization solution for monitoring commodities, but we definitely still see there being a big role for physical inspections and CMAs, and them being a partner in that process and leveraging technologies where it's appropriate, but also, having that ability to, front a customer, attend a site, conduct an audit, those kinds of activities as well. But I think what can be improved a lot is the digitization of their processes, the collection of that data, the connection of different pieces of data. So, for example, you may have, measurements around the quality and quantity, but you also want to know the condition of the facility. You may also be concerned with things such as safety records or other components to, that storage facility, or other concerns with that storage facility. So, yeah, I definitely do think that there'll be an increasing role of digitization for CMAs, and there'll be or inspectors, and there'll be an ongoing role for them, but it will change as the technology is adopted.
Thank you. One additional question that we have here is how can banks leverage back the office system for new business generation and loss prevention from fraud?
I can start with this, given it's something I've worked in the last 15 years. I guess some of your, one of the key things that institutions want to do, and we said this at the very start, where the crisis and COVID has made technology an enabler. It's fast-tracked the connectivity of humans, as Diane said earlier, humans to technology. And in terms of that, back office systems no longer want to remain in isolation. And therefore, they're looking for technology or internal capabilities to connect that back office systems to your front office systems. And therefore, if I think about your back office systems being your reporting systems, your systems where you're bringing all of your data together and just more from a collection perspective, how can I use those back office systems to help me in front office when I need to go originate a loan, when I need to go and decide on an automated way whether I want to lend to Olivier or not in terms of that credit decisioning. And therefore, from a fraud perspective, what you can do is be able to use that same data that's in your back office, connect it with your front office customer solution or your credit origination solution. And that is where you then have your fraud detection play coming in, or you have triggers to set up or identify where, if this is a first party fraud, or if this is a mule fraud or a bust out fraud, you're able to have flags as part of your front office to identify any fraudulent activities. And one of the key things to be able to connect your back office systems to whether it's fraud or better holistic risk management is the data. So do you have enough data in your back office system that can give you insights whether it's going to be fraudulent or not? And that is kind of the first base. And we'll talk a lot about data, and we have talked a lot about data, but it's how can you connect data and your media, your adverse media, and your kind of global outlooks. That's what's happening in different newspapers and different websites into that back office connectivity to front office to help you with that fraud risk assessment.
Thank you very much. I mean, I see the time is flying. We've got only 4 minutes left. I do have maybe a last question, and I will invite Alex to answer to that if it fits to what he does. The question is, does the panel think we are now looking at a two-tier system with flight to quality on lending for some of the larger lenders, and a space for providers such as those in this panel to provide risk products that offer greater certainty? Is the size of the gap between these two groups healthy, and what more can be done to reduce it?
Yeah, it's a great question. And as mentioned earlier, I think we see from the crisis more an opportunity. So when we present our business model, we see more players coming to the space. So it's not only the traditional big banks, we see the regional banks coming in, we see asset managers coming in. And this is where data is doing a great job, because it breaks the silos, it makes it more inclusive. What we're seeing is more, and this is also what Roshni was spot on, more holistic system where people sharing their data across systems. We understand the sensitivities, but this is where we are coming in from a technology point of view and trying to bring in more players into the game to give them more comfort, more trust. Because as we said, and there are two things I would like to highlight here, there's a significant increase for supply chain finance, and we go exactly what you said, Olivier, we go one level below. The significant demand in particular from the SME space and emerging markets. So this is still a very untapped market. And the second point is like what Diane mentioned before, data is very important and data accuracy, but the human aspect will always remain, right? So what we're trying to do is really to automate the emails back and forth and all the attachments of Excel sheets and PDFs. This for sure can be automated, right? This for sure will be history, and we're moving now to 2022, but the human connection, and we call it the connection of a network of networks, will always remain. And this is where we're trying to bring in new players, SMEs, family offices we've seen recently, regional banks who are tapping into this space. And this is where we're trying to create solutions.
Excellent. Thank you so much, Alex. We have 2 minutes left. Anyone before we close on this topic?
I might jump in for a second, just listening to Alex talking about, I think there's a space for large and scale and smaller and sort of more bespoke. And I think you'll find the market will find its place there. I guess one of the reasons why the government schemes, loan schemes in Australia haven't been as tapped as perhaps the government wanted to see is because the market was serving the market. So I think that's kind of good news. But I think there's 3 things that we just kind of have to accept about this next phase. And that is that the pace of change is going to continue to be fast. So that's not going to slow down. We're going to have to get used to ambiguity, right? This uncertain world and volatility. And also that, humans are important. And I think that we need to make sure that that judgment is not lost in the rush for, the sexy AI solution. So I think if we find something in there, pace of change, uncertainty, and humans, what does that say? It means we need to be holistic. As Roshni said, she's spot on.
And the only thing I would add to what Diane said, Olivier, is insolvencies. Diane, you started with this at the very top of the hour, right? We may get more insolvencies, but it may not be that the industry has failed. It could be because of due diligence purposes. So whilst the crisis is, we're seeing an upscale in that, it may still mean that we'll get insolvencies for various different reasons.
Thanks. Thank you. On this great note, I thank you all in the panel and thank you all in the audience for the great questions. And looking forward to the following of the conference. Thank you all and goodbye.